What's happening, Hardscapers? This is episode 241 of the How to Hardscape podcast, where we talk about how you can start and grow your hardscaping business. And on today's episode, we have a takeover episode with our friends at Cycle CPA. This one featuring Joseph Policastro, and he gets into some great stuff on industry average benchmarks, percentages, gross profit margin percentages, direct labor cost percentages, and so much more. This is the great thing about Cycle CPA. They specialize in our industry, so they're able to take data from all the companies that they have dealt with, do deal with, and are able to compile it into industry average benchmarks. And this is great information to be able to see where your company falls into and how you can improve your business to catch up to those benchmarks and hopefully one day exceed those benchmarks, especially when you're growing and hoping to grow. These percentages really help you stay within a healthy percentage, because if you're falling below a certain percentage, maybe it's time to hold the brakes, stop the brakes on growth and focus more so on profitability, and then eventually get back to growth. But if you're looking to talk more with Cycle CPA, especially when you're getting into tax season here, get your books in order, contact them, www.cyclecpa.com. We're very thankful to have them as long-term now partners of the How to Hardscape podcast. So we do want to say thank you to Cycle CPA for supporting the show, bringing you this content. And they always have educational content over on their Instagram channel. That's at cycle_CPA. Check them out there. They've also got a Facebook group that they talk about. And without further ado, let's get into today's episode.
Hey everyone, super excited to be a part of this episode here in How to Hardscape. My name is Joe Policastro. I'm one of the co-founders of Cycle CPA. So we do accounting and tax services remotely for companies in the green industry. And a big part of that is working with hardscape companies. So we're able to kind of utilize some of the data and information as we're performing the accounting work to then pass on some of that guidance and value over to our clients in that way. Now today, really, I wanted to go over a couple different things, right? And it all starts with having a solid accounting foundation, right? And being able to kind of analyze that data. But then also, really the biggest piece of that is using the accounting and financial information to make important managerial decisions in your company, right? So basically going from, making a decision based off of your gut feeling or what your friend's doing down the street in his business versus, making that decision based on what the numbers are showing you, right? And as I mentioned, before you can get to any of that fun stuff and analyzing the numbers and going through all of that, you'll need first to have your accounting foundation set, right? So most of our clients use QuickBooks Online, and it's great that you have the different softwares to utilize in the field to help manage that aspect, whether it's Synced Up or LMN or Build a Trend, stuff like that. But ultimately, you need an accounting software, right? So like QuickBooks Online, more specifically, it's a cloud-based platform, so you can use it, in whichever computer or laptop. And part of that is, when you're initially setting it up, and even as you're organizing it, is making sure that the chart of accounts is set up, right? So that's basically the buckets that all of the banking transactions and credit card transactions get put into. So one of the biggest reasons to make sure that your chart of accounts is set up accurately is, for instance, you may have field labor people, right? So people that are working in the field and they're directly working on the projects, right? Versus overhead labor, right? So those are people that may do sales, administrative work, management, right? So they're not actually physically working in the field. And an example of why the chart of accounts is so important is because ultimately you want those two separated, right? You want to be able to see what your field labor is within your direct costs, but then also your overhead labor, which falls within your overhead, right? And the reason that you want things like that to be accurate and the chart of accounts is because then ultimately you're going to be comparing it to previous periods. You're going to be able to narrow it down to, okay, are we having an overhead issue in the company or more of something that's in your direct expenses? and should we focus more in on that? Also, even being able to compare it to industry averages, which I'll get more into as well within this episode. But making sure that your chart of accounts is set up correctly. And part of the difficulty with this is, especially if you're part of Facebook groups and different things like that, it's tough to compare your numbers sometimes to what your friends are doing or what other businesses are, because you may not really be comparing apples to apples. So it's something you want to be careful of. And then also not getting discouraged, right? If someone says that they make a 35% net profit, do they really understand all the expenses, and are they really taking into account all of those, like depreciation or some of the overhead costs that are involved with running the operation? The other piece is the bookkeeping, right? So as I mentioned before, it kind of ties into the chart of accounts, right? But it's basically categorizing all the transactions. Then you're going to reconcile the accounts. It's basically making sure that whatever is in your QuickBooks mirrors what's in your business bank account. Then you're going to want to do a month-end close, recording depreciation, reconciling loans as well. Making sure that everything is tied out, right? Because, yeah, it's nice to be able to see the financial reports, and ultimately you want to see your financial reports on a monthly basis, but you want to make sure that they're reflecting what's actually going on in the company. And a big shift that companies take, or that you should be taking, when you first start off, your priority is to maybe grow the company, right? Really try to market in the community, get your name out there, build a client base, get some key team members to kind of launch the business. But then as time goes on, you're going to want to, instead of just getting the accounting done just for compliance purposes at the end of the year, just for tax season, instead of just doing it for the IRS, you should be doing it for yourself, right? And what that is being able to utilize that information, as I kind of touched on briefly in the beginning, to make the managerial decisions in the company. And that's what managerial accounting is, right? So you have the tax side, which is great, right? Because then ultimately you're going to be able to utilize that information, right? And working with someone that handles the taxes, making sure that they can decrease tax liability as much as legally possible, right? But that's completely different than what an accountant from a managerial perspective looks at, almost like a CFO, right? They're looking at things in regard to helping with cash flow, increasing profitability, managing risk, looking at, so like an example would be analyzing the return on investment with certain moves that you're making in the company. So maybe you're considering to, really increase wages, right? So yeah, you might increase your wages, right? And you might pay your people better, but in return, are you actually able to retain people longer? Are you able to attract better talent, right? Which is going to decrease the amount of load that's on your managers, and it's going to take some stress away from that part of the business, right? Also, an example, like looking at the ROI based on marketing spend, for instance, right? So I know a lot of companies, they may really be proud of the fact that a lot of their business comes from word of mouth, right? But is that word of mouth referral, is that the best customer or potential project that there is to kind of work with, right? So if you spend more on marketing, are you able to have a larger funnel, right? Can you be a little bit more pickier and work with more of the profitable projects? You can even be a little bit more targeted, right? And what does that impact on the bottom line? So these are all different things that you would kind of look at, right? And that's really the managerial accounting perspective. And really what I'm going to go over today is, okay, how do you use your financials to make important business decisions? And it ultimately stems from the three main financial statements, right? You have your income statement, also known as your profit and loss statement. It shows how much money your landscape or hardscape business earned and spent over a specific period. So you can look at it, on a monthly basis, quarterly, yearly basis, and it'll show the total revenues coming into the business, expenses, right? So whether you're looking at some of your direct costs or overhead costs, direct costs being everything that could be tied to that specific project, like materials or field labor, versus the overhead expenses, items that are kind of those back end expenses that just pile up over time, right? Like marketing or professional fees or utilities, rent. And then, you can ultimately see what your net profit is, right? So after all those expenses, you also have the balance sheet, right? Which is that second financial statement. And this statement, it shows a snapshot of your hardscape business's financial position at a specific point in time. So it basically shows what your business owns, which are the assets, what it owes, which is the liabilities, and the owner's equity. So owner's equity being basically, it's taking what the business owner owns within the company. You also have your cash flow statement, right? So this tracks the movement of the cash coming into and out of the business over a specific time. And one of the nice things about this is, so you can basically look at, okay, what is the cash being generated based on the operations of the company? What is the cash spent on some of the long-term assets, like your equipment, right? So from the investing. Also looking at the financing, right? So looking at the cash that's being borrowed or, repaying loans, different things like that. So these are the three financial statements. So the profit and loss statement, balance sheet, and cash flow statement that ultimately give you a picture of what's going on, what the financial health of the company is, right? And now this could get relatively complicating, right? Or boring, right? If you're just looking at these financial statements or you're looking at spreadsheets, because ultimately you're going to want to be able to use some of this information and simplify it to a degree, right? When you're looking to make the certain decisions in your company. Now, for instance, some of the higher level items that you may want to look at within your profit and loss is your net profit, right? So that's basically all the profit after all the expenses in the company, right? So based off of the data in Cycle CPA, of the companies that we work with internally, for this year, within 2023, the net profit for the install-based companies was around 7.4%, right? And your gross profit that we've seen thus far this year, so it's basically that compilation of data that we have, also known as kind of like benchmarking the information, was around 40%. Now the gross profit, that's what's left over after all your direct costs within your profit and loss statement. And ultimately, we always recommend for companies to shoot higher for these industry averages. But that just kind of gives you an idea. And then also when it comes to profitability, right, you can look at things like, okay, there's a reason that you guys are investing your time into a hardscape business, right, versus maybe just buying real estate or investing in the stock market. You want to ultimately get a return on your business that is more than those different options, right? Because there's more risk associated with a hardscape company and just running it. So the return on equity, so basically the return that you're getting on your business and the funds that you've invested into the company, the average that we've seen this year in 2023 for hardscape businesses is around 49%, right? So, which is basically just your net profit over the equity, right? So those are a couple of the higher level ratios and percentages when you're looking at the profitability of the company. And this is ultimately going to help you know not only where you benchmark to other companies in the industry, but you want to be tracking this progress as well, whether you're looking at trends or which is something that an accounting firm should be helping you with. Then, maybe you're looking to purchase a skid steer, right? Or purchase another fixed asset, whether it's equipment or truck. Now, where do you even start, right? When you're looking at a specific decision like that. Now, because we work with a lot of companies in the industry, we've developed kind of a system around making those kind of decisions and specific ratios that even go hand in hand with that. So if someone's looking to purchase, let's say, a new skid steer, right? We can basically show, okay, what is what is the return on your current fixed assets that you have within the company? So for instance, if you take all your net profit that the company generated and you divided it by all the fixed assets of the company, so all the equipment and the trucks, the average for a hardscape company is around 36%. So you can utilize that and say, okay, listen, if I'm making a little bit less of a return, why is that? Do I need to potentially sell something? Do I need to just rent something instead if I'm not utilizing it as much? Also looking at cash on hand levels, right? Because, yeah, you can go ahead and purchase an asset, but how is it going to affect your reserve cash, especially if you're entering the slow season? How is your repairs and maintenance trend? So the amount of money that you're spending on just maintaining this equipment and the trucks, if that's increasing over time, then that can be another indicator that, okay, maybe it's time to start replacing some stuff. We can even look at, okay, how new are your assets? And there's a ratio called fixed asset newness. And I'm not going to go into all the details, but it basically shows, okay, how new are the assets within the company? So if the assets are showing that they're getting a little older, it's a good clue for the company to kind of get ready, build up that cash reserve, and be expecting that, you may have to start replacing some of those equipment and trucks. So it kind of goes from, making decisions based on your gut, right, versus using some of these ratios, right? Because we know that these certain decisions are going to be coming up in the business. It's really not a surprise, right? There are certain things within this industry that are going to come up. So it's just being able to prepare yourself, right? Also looking at things like leverage, right? Now, and you may have heard this term, right? Sometimes companies refer to it as over-leveraged, right? If a company has too much debt. And basically what this means is you're basically taking on debt to help leverage and for you to basically grow faster than if you were to just almost save up the money to just purchase something all cash. And it basically means you control more assets with less of your own money. And that's basically a way to sum it up as well. Now, one of the things you can look at in regard to leverage, right, is liabilities to total assets. A way you can almost imagine this is looking at your liabilities like you were to look at your mortgage in a house, right? So, and then you look at your assets as the home value. So if a bank was going to give you a loan, they would want that mortgage to make up a smaller amount of the total home value, right? Because that's less of a risk for them. You have more skin in the game. Now, it just so happens that the industry average thus far in 2023 is around 62%, right? So, which is basically just the liabilities over the total assets. So it's just another way you can kind of analyze the company. And we have a couple other ratios that indicate this, right? So you could basically look at it as a snapshot, right? Especially as you're growing. So like I said, you can make sure that you're not over leveraged and using too much debt. And listen, there are some companies that we work with that don't believe in using debt, right? Which is fine. But it's just finding what you're comfortable with, risk level, right? Kind of going back to what I mentioned before. That's a big part of even the role of a CFO, right? A chief financial officer within a larger company, right? Is basically being able to manage risk, right? And this is one of the key things that kind of goes along with that. Another example of utilizing the financials would be looking at labor efficiency. So whether you're 200,000 revenue looking to go to 600,000, or whether you're 2 million in revenue going to 5 million, or whatever stage you're in, right? If you're looking to grow the company, you're going to want to be looking at the financials and basing your information off of that. So as I brought up before, if your chart of accounts is set up correctly, you should be able to specifically see just the employees and the labor that are considered field labor or direct labor, right? Which falls above the gross margin line, right, within your direct expenses. So that figure within the hardscape businesses is roughly 16 to 18%. Thus far this year, up until November of 2023, for this year thus far, it's around 16%, right? So if the company made, let's say, 200,000, then it would be 32,000 would be allocated towards the direct labor. Or you can look at it like, for instance, if the company was doing $1 million, 160,000 was spent just on the employees within the field. So now, if you're looking to scale from that point, and if you're looking to add, let's say, another 500,000 to the business in the next year, that ratio should stay relatively the same, right? So it would be roughly $80,000, right, that you would have to kind of allocate if you were to be spend another 500,000. So and I'll kind of, and that's sometimes companies, they're basing this information and scaling their company based off of what their workload is now, or especially we see this especially even within the overhead salaries, right? So maybe some of the people helping out in the office or managerial or sales, maybe your problem is not necessarily adding on people. Maybe it's just the systems and the processes and the technology that you're using within the company. Because if you're not utilizing those and you're not efficient, then you're going to have to spend more on labor. And that's ultimately why a lot of these CRMs and field management softwares were created, ultimately to lower labor costs, right? And to make things more efficient, right? So you want to be able to utilize these, right? And increase the amount of revenue that each employee is basically bringing to the company. Now, for instance, if you want to add a overhead employee, right? So for a hardscape business, it could be anywhere between 6 to 9% of total revenue, right? Where you're going to basically be utilizing those funds to pay administrative management employees. So if you're looking to hit $1 million in revenue, right? You'll know, okay, I have, let's say, 60,000 to 90,000 as that bucket to basically spend for the administrative help. And there's times, especially the faster your company is growing, the more you may have to hire people a little bit ahead of time before you have all the revenue to support it. But you want to make sure that in situations like that you're confident in the other aspects of the company that will lead to that growth, right? So you're confident that you can, for instance, that you can market and you can get the customers to come in to then hit that $1 million mark. Because sometimes we see companies, right, where they're budgeting for the next year and they have an aggressive revenue goal, but they may hire some of the overhead staff ahead of time, which is fine, right? But what that in essence does, it just increases your risk a little bit more, right? Just as you would utilize debt, and if you don't hit your goals, then now you have more money to basically in your liabilities and more money that you have to pay back. It's a similar circumstance with adding on overhead labor a little bit ahead of time. Now, if you don't hit your revenue goal, now you have a little bit more of a fixed cost, right? So it's always something you want to be a little bit careful of. But on the other side of it, companies that grow faster, they typically have to incur a little bit more risk, and you may want to do stuff like that, right? Where you're maybe adding on some of the overhead labor, some of the administrative and management a little bit ahead of time, because ultimately those are the people that are supporting the most important part of your operation, which is the field operations. And if that part of your operations is not being supported, then your company is going to be going in the opposite direction, right? So, I think a growing company in general is going to have to be spending more time on training, may have to use a little bit more debt, may have to, spend a little bit more money ahead of time with the overhead salaries. But these are all things to kind of consider, right? But ultimately, you want your numbers and you want to hold your team accountable to all these figures. And not just on a yearly basis, but you want to revisit this stuff either monthly or quarterly and see, okay, how is the team performing, right? If you do hire a salesperson, are they meeting their goals, right? Even the team within the field, right? Whether you're looking to open up a new division with a different service line, or maybe you're looking to exit the field more and work more in the office. Do you have some of these numbers that you can go to monthly or quarterly and hold your team accountable? Because that's what it comes down to. Another example is looking at things like liquidity, right? So, especially, this time of year heading into the winter, it's the slow season for a lot of companies, right? What was done this year to prepare for that, right? One thing that we look at within the reporting is your net cash flow. So a lot of companies, as I mentioned before, right, the average for your net profit for hardscape companies this year was around 7.4%. And however, there are some aspects of the cash coming in and out of the company that are not reflected within your profit and loss, and then ultimately your net profit. Things like loan payments or asset purchases, those fall on the balance sheet, but they have a big impact on the cash coming in and out of the company. So just because the net profit was 7.4%, that doesn't mean that's the money that you end up keeping. Now, the average, which is pretty surprising, but the average net cash flow, so the actual amount of cash coming in and out of the company, was 1%. So there's over a 6% difference in that. And that's something that ultimately, when you hear about some of those statistics of companies that go out of business, right, due to cash flow, but these are the certain ratios that you want to monitor, right? And you want to make sure that you're developing goals for these different metrics and that you're coming up with a plan to improve, right? Whether you're going to increase pricing for next year, or you're going to not only increase pricing, but you're going to find a way to produce more, right? With the amount of people that you have through adding technology or making certain improvements within the company. And when you look at things like your net cash flow, ultimately there's patterns to it as well. And sometimes, especially with more install-based companies like hardscape companies, the answer is not doing more. The answer is maybe changing up the processes and the systems. Maybe it's, right now you take 2 or 3 progress payments. Maybe it's not even changing the amount of progress payments, but it's collecting a higher percentage up front now. And even if some of the companies or, some of the clients, they say, listen, I'm not comfortable with giving you, this percentage before the project even starts. You typically won't lose anything if you ask, right? And I think that's, so don't be afraid to ask, because I think you would be surprised, because if your company is really operating and you're showing the customer the value that you can perform at the property and the beautiful work you can do, there's typically some wiggle room with things like progress payments. So like I said, maybe it's increasing the amount that you could take up front. Maybe it's increasing the amount of progress payments. So maybe going from 2 or 3 to maybe 4 or 5 progress payments throughout the life of the project. And these are things that can really help your cash flow, right? Are you prioritizing your accounts receivable and collections process within your company? Do you have processes for that administrative work, just as you have processes for some of the work within the field? Because as a company scales, you don't want your accounting and administrative processes to be your bottleneck, because that's what it becomes. Whether a company is at, and we see it in different stages, right? We see some companies where they're 200,000 and they've reached that bottleneck. We've seen some companies where they're 4 million and they've reached that bottleneck, right? But ultimately, I don't think any of you guys want that to be a bottleneck for the company. So prioritize it just as you're prioritizing the work in the field, right? Just as you're wowing customers in the field, wow your administrative employees with the processes and the checklist that you have set up. At Cycle CPA, we have a software called Trainual, where we have dozens and dozens of videos that not only train accountants on the green industry, hardscape companies, but also our specific processes, right? And what does that do? That decreases the amount of time that they'll need help from a manager, right? So it helps with efficiencies. It helps for your employees to build confidence. So all certain things to kind of consider. And because we work with a couple hundred companies within the green industry, we've been able to develop a new comprehensive reporting, right, which is called Cyclescape reporting. And we're pretty excited about it because really, in essence, what it's done is it's taken some of the spreadsheets and some of the QuickBooks reports, and it's turned it into more of a digestible and usable report and metrics that can help companies make decisions, right? So you can actually see, okay, how do your numbers compare to last year? How do your numbers compare to industry averages? And for each specific line item or ratio, it'll show what percentile the company falls into. So whether it's labor efficiency or whether you want to buy an asset, you can have a quick glimpse at this report and it can give you that guidance into what decision may need to be made, right? So we do all of the bookkeeping and accounting as the foundation, right, which is important, right? And it's important to, even if you're not getting something like the Cyclescape reporting, you want to be seeing financial information on a frequent basis, right? More of on a monthly basis, right? Where you're able to make these important managerial decisions within the company. So I think that we're at an exciting time of the year, right? We're entering 2024, and it's the time of year that you want to look at, okay, how did the company perform in 2023? What are things that you want to do differently moving to 2024? And instead of having that mindset of just at the end of the year, as I mentioned, right, keeping the progress more than once a year, right? Looking at it January, February, March, April, or every quarter. So that way you can really measure your progress throughout the year. And if you have any questions, you can always reach out to us at cyclecpa.com. Use the How to Hardscape promo code as well for a discount off the catch-up work, which is something we can help with as well. But feel free to reach out if you have any questions. And I hope everyone has a profitable start to their 2024. See you soon.
Thank you for listening to today's podcast episode. Once again, check out Cycle CPA, cyclecpa.com. Let them know How to Hardscape sent you for money off their services there. And definitely follow them for educational content around the same at cycle_CPA on Instagram. And their Facebook group is Landscaping Accountant. Definitely join that group for more educational content there. And we look forward to meeting with you next week on the How to Hardscape podcast.